Okay, so we have two more topics to cover in the leases chapter, and then we'll be able to move on to deferred taxes. The first topic I want to talk about are the initial direct costs of the lessor. So what are these costs? Essentially, they're going to be finder's fees, negotiation fees, preparing and processing documents, legal fees, anything that the lessor has to incur in order to create the inception of this lease contract. Accounting wise, we want to handle the initial direct costs differently for each type of lease that the lessor could involve itself in. The overriding theme here is the matching principle. We want to recognize any expenses in the same period that we recognize revenues. And so it's going to change slightly for every type of lease we have. For an operating lease, since the rent revenue is earned evenly over the life of the lease to the lessor, we record any IDCs as a deferred asset, and they're going to be allocated over the life of the lease term. So straight-lined it, amortize it, take a prepaid asset in the value of these initial direct costs, divided over each year that the lease is in contract. Very similar to how we used to account for bond issue costs, but not so much the case anymore. In a sales type lease, we expense these in full as a part of cost of goods sold when the profit on the sale is recognized. Since a majority of the profit in a sales type lease is recognized at the sale of the lease, that's when we want to recognize or match the expense of initial direct costs. For a direct financing lease, this one's a little special. We're going to add these costs to the lease receivable. When we add these costs, we have to now, because we are altering the present value, we have to calculate a new effective interest rate. And what that's going to do to the interest rate is, as I increase the present value of an item, that leads to a falling interest rate. Since we have a falling interest rate, this will force me to recognize less interest revenue. And I'm going to account for this expense over the life of the lease by reducing the amount of interest revenue I would recognize on this lease than I would if initial direct costs had not been present. Right? And again, this is going to match the flow of interest revenue over a direct financing lease, which is the primary sort of revenue we recognize in those types of leases. So everything with the matching principle, we want to make sure that we continue to apply that throughout our accounting. Now, in this case for Stratton Tella, which are two companies involved in a lease, in this first case, I have them classify the lease as operating to both parties. It's a 5-year lease, annual year-end payments, beginning of the year payments of $60,000, and initial direct costs were $10,000. So I give you some information about the cost to the lessor, the estimate of the useful life. And this will all be very important in order to figure out the total earnings effect for the lessor. So what is the first thing that we want to do? Remember that if we're receiving cash as the lessor at the beginning of the term, we now create some unearned revenue that we have to earn by providing the leased asset to the lessee. At the end of the year, of course, we will reduce this unearned revenue and record sales revenue, just sort of making sure you remember how to record this as an operating lease. It's very simple, but some people tend to forget it amongst all the difficulty of a capital lease. We also have to record depreciation because remember, if it's an operating lease to the lessor, they still have it on their books. So we have a cost basis of $40,000, a useful life of 10 years. That will result in a depreciation expense of $40,000 each year for the lessor. The final item that we would have to record are any indirect costs as a prepaid asset. So we have a prepaid indirect cost of $10,000 paid with cash, 10,000. Then we record an expense. You just call it a lease expense if you want, or an amortization expense would be fine as well. Because that's the general term for reducing anything, right? So what are the overall costs borne by the lessor? What are the revenues? We have a $60,000 revenue less the $40,000 of depreciation expense, less, oops, sorry, I took the whole thing out. Remember, we only want to recognize this ratably over the life of the lease, and that would be $2,000. And so overall then, for the first year, the lessor would record $18,000 of income from this lease after the costs have been dealt with. Remember again, the reason why I screwed this up, I had the prepaid initial direct cost of $10,000 with cash. That should be split up equitably over the lease term of 5 years, so $2,000 per year. Now we're going to do a sales type lease with this. I'd say that the lease cap is capitalized by both parties. Still 5-year lease, annual payments of $60,000. I changed the cost, so now that is the cost of goods sold to the lessor. I say that the lessor incurred initial direct costs of $15,000, and the equipment has a market value of $250,192. No residual or bargain purchase option in the lease, which indicates that my future value is going to be set to 0. Now, in this case, I want you to assume that the present value of the lease contract is equal to the fair value of the leased asset. And I tell you that because we have to have a present value of the lease contract known in order to figure out what the interest rate for this would be. And so in this case, I'm going to have a present value of the lease contract equal to the market value of that machine or whatever we're leasing. We would have a future value of 0 because there's no residual or bargain purchase option. It has a term of 5 years. We have payments of $60,000 happening at the beginning of each year. And that would indicate, when you solve for it, it would impute an interest rate of 10%. So how do we know it's a sales type lease? Just remember, of course, we want to compare the cost of goods sold and the market value of the item that's under lease. And in this case, then we have a sales type lease because we have some profit between what the market value of the asset is and what the cost of the asset was to the company that is leasing it. The lease receivable, remember, will be recorded at the present value of the lease contract less the initial cash payment of $60,000. So we receive $60,000 of cash, which reduces the lease receivable from $250,192 to $190,192. Inventory will always be at the cost of the item to the lessor. Of course, they recorded a historical cost on their books. And so when they lease it in a capital lease, they take it off their books at that historical value. Because there is no UGRV, the lessee would have to pay this much as their MLPs. And therefore, we can record that much as sales revenue. We don't have to subtract off anything, no UGRV here. COGS would be just the inventory cost, except that we have $15,000 of initial direct costs, and we want to match that to the sales revenue we just recognized. And so we add it into our COGS number, as just part of the cost of that item. And the only thing that's left is we have to show a cash outflow of $15,000, and that is those initial direct costs. So then, to answer the question as how it affects earnings, we just take the revenue item, $250,192, subtract off the cost of goods sold, $175,000, and then recognize that we'll have a little bit of interest revenue here. Remember, the interest revenue is going to be the lease receivable, 190, 192, multiplied by the interest rate that we imputed of 10%. That gives me $19,019. Oops. And that would be the earnings effect for this lease in the first year. And again, notice, of course, we don't have any more initial direct costs to expense. We've recognized them all in the year of inception. In the final case, I bet we're going to do direct financing, and that's correct. We have the cost being equal to the fair value of the asset that we're leasing. And when the COGS is equal to the fair value, that implies a direct financing lease. Remember, in a direct financing lease, the only revenues that we actually are recognizing as the lessor are interest revenues. There's no sales revenue. And so we want to match our treatment of the indirect costs to that revenue recognition. So remember, you're going to have to add these costs to the lease receivable. And I know that seems a little counterintuitive, but trust me, it'll work. We add it to the lease receivable to get that present value of $265,192, which is just our original present value modified by the indirect costs. Now, because this is a new present value, my old I will no longer amortize this lease correctly. I have a future value of 0 because there's no end of term deal. The payments are still $60,000. My lease term is 5 years, and I use that to determine a new I. So that implies that I in this case would be about 6.576. So this is a lower I. How does this affect the initial recording? Well, not a whole lot. We have a lease receivable that we still record as the present value less the initial cash payment. And we still have inventory. That is $160,000. Oops, sorry, I changed that. $250,192. I was going to write 160, but then I forgot I had to alter it in order to make this a direct financing lease. Cash of $15,000 is paid in order to satisfy the initial direct costs. So where does this come in then? Remember, when we record interest revenue, we would now have a new interest rate to apply. So we're going to apply that interest rate to $205,192. And we get a value of $13,493. So as you can see, we're going to recognize less interest revenue. So there is no expense that's recognized per se. We just net it from the amount of interest revenue we would have recorded if this lease had not had initial direct costs. So another item that sometimes comes up, and that's mentioned in your book that I think is pretty interesting, is that there can be a case where the lessee will seek a third party to ensure any residual value that is needed to be guaranteed in a lease contract. Now, why would they want to do such a thing? Right? Well, if you think about it, any guaranteed residual value is going to increase the present value of the MLPs to the lessee. Remember, I told you that lessees want to record leases as operating leases as much as they can. Well, the higher the present value of the MLPs becomes, more likely to capitalize because of Rule 4. So if we're more likely to capitalize because of Rule 4, if we have a GRV that represents a future value, well, then let's just make that future value 0. One great way to do that, have someone else insure it. So you pay some interest expense for the lease term while the insurance company says, hey, whatever amount that you don't come up, that asset is not at, we will make up for the shortfall, and the company no longer has a GRV. Everyone is happy. No lease is recorded as a liability and an asset on the lessee's books, and the lessor can still probably record it as a capital lease because they're going to have a future value as the GRV. Only the lessee would set it to 0 in that case. One interesting aspect of that sort of deal is that IFRS does not have these bright line classifications for leases. There's no 75% rule, there's no 90% rule, there's no BPO automatic capitalization rule. IFRS says simply look at the risks and benefits of the ownership of the leased asset, and if they are substantially transferred, then it should be recorded as a capital lease. So we don't have these sort of numbers that can be played with under IFRS. Therefore, even with a third-party guarantee, it could still be likely that an accountant working under IFRS would say that this lease should be a capital lease for the purposes of recording it. I want to cover the last part of this in class, simply because I believe that it requires a fair amount of explanation, and I would like to kind of talk about what's going on at each part and show you the amortization table, show you the present value, how the present value plays into this, and therefore we can get through that and then work something else in class as well. Thank you.